Right, folks. Good morning, good morning, good morning. So, thank you as always for attending, and thank you to FX Street for hosting these sessions. I have a little bit of a question and answer session planned in mind, which is really dependent on if you ask a question. So, if you've got a question, please feel free to ask away, and I will do my best to try and answer it. So, Pat's got a first question up there, a bit more of a general, about the setup. I've actually got 3 modules. The question is, how do you set up your workspace? How many screens do you have? Do you have any tips that I can suggest? I've got 3 monitors, to be fair. 2 are used for charting, so basically the same as what you see now on your screen. This is pretty much what I'm looking at. My workflows, you can see at the bottom here, I've got several tabs in that. In fairness, I don't use all of these. There's only really 3 that are actually used for actual trading. One of the main ones that I do like to use is basically have an overview page so that I can see exactly what's going on, but at a glance. The time frame doesn't really matter. I've got a 60-minute chart on here, but I can just see the currency cross rates that I'm looking at a glance, so that I can, again, see where price is, what price is doing. I don't have to then constantly flick through different tabs all the time back and forth. So I can pretty much stay at one overview page, if you like, and then drop down to the more detail. So for example, it might be that the euro yen, it's just near some trigger levels. I mean, these are some trigger levels that I'm interested in. So price is near a level that I'm interested in participating in with a new trade. So it might be then that I'll drop down to the euro yen tab, and then this would be my trading setup. So I've got a more detailed overview. I can see the higher time frames, the lower time frames for my entries. So then I can be thinking about a new trade setup. So then drop down to the lower time frame. That's pretty much my workflow. That's pretty much my workflow. This is my normal stomping ground. This is what I usually look at when I'm looking at an individual currency. As you can see here, I've got euro, yen, and pound, dollar on the screen here. I'm basically just waiting for price to react to a level that I might be interested in. For example, here we've got prices retracing to a level. Again, a level I'm interested in. I'm not going to talk about the level itself. Basically, prices retracing to a pre-identified level of interest. And what can we see here? This is something we talked about last time, actually, the price action sequence. This is what I was going to talk through in the absence of any questions. And basically, the price action sequence, it really is the core foundation of everything I do. So in the absence of any questions, I'll run through that again. And this pattern here probably will make more sense to you after that. But this is my usual stomping ground anyway. This is my normal workflow. Some tips on chart setup, more to do with the psychology of trading, if you like. What I personally prefer is to have no reference to my positions, no reference to my accounts, no reference to my profit and loss. I do not like them in my line of sight. I personally find them distracting, and they take my attention, or having them in my line of sight takes my attention away from what's important. And what's important is trading the plan. So I'm trying to execute a trading plan with as much precision as possible. And I do not want to be distracted by the profit and loss. I don't want to be distracted by my open orders. I don't want to be distracted by, basically the oscillations in any open positions. I personally just find it very, very distracting. And it's also a more stress-free day when you're not looking at your profit and loss all the time. One of the traps you can fall into as a new trader is to basically just be monitoring the open position constantly like a hawk through the day. And what you end up doing is trading the profit and loss. You see that your $50, $100, $200, $300, $1,000, whatever your position size is, you see that you're X amount in profit, and you get all excited. You say, oh, right, I've got to take it. But in reality, it depends on the position size. It might only equate to a very, very small profit, whereas your strategy might dictate that you're looking for a larger profitable, larger movements in accordance with your strategy. So you get distracted very easily by the profit and loss. You just see the money and you see that you're in profit and you think, I've got to take it. And then what happens is your emotions override the strategy that you've pretty much spent a long time developing and researching and back testing and forward testing. And it just all of a sudden gets thrown out the window. And I've got to admit, one of the best things I ever did was remove from my line of sight every reference to an open position that I have. So that's probably one of the best tips with regards to chart setup and workflow, and that I could ultimately suggest. So just going down to seeing some of the other questions. So I'm not going to answer them in order. How many time frames do I use? Well, in fairness, although I've got a 60-minute chart for an overview, I don't actually use this for trading. I pretty much try and use this just to try and get a handle on what's going on from an intraday movement point of view. So this is more for the overview page, as I've already touched on this other page. I appreciate there's a little bit of a lag, but what you should be seeing is 4 charts. This is my usual setup. I'm typically a 2 time frame trader. I have a really high time frame of 480-minute charts. And I've got a low time frame for my entry, which is 89 tick charts. The 480-minute chart is basically splits the day up into 3 sessions. Now, this is basically an alternative to a daily chart. So if you think about normal, most other instruments, trading instruments, futures, stocks, commodities, typically they have an 8-hour session, during their normal trading period. Obviously, these days there's 24-hour traded markets becoming more and more common. So what's actually, where were we? Oh yeah, so the 8-hour charts for me, it basically splits the day up. And bear in mind, we've got a 24-hour market on currencies, and it splits the chart up into what might typically be represented into 3 trading sessions or 3 days. So with every bar, this is kind of like an alternative to a daily chart. So again, it just enables me to see what pretty much every trading session is doing. You've got basically the Asian session, the UK session, and the US session. Now, I do appreciate there is an overlap between all those sessions, but it does split the day up quite nicely and make it more comparative, a more realistic alternative to a daily chart. Again, the lower time frame, the 89 ticks, this is my typical entry time frame. It's with the 89 ticks, this is relative to my data. So what I'm trying to achieve with the tick charts is an average, an approximation, an average that is equivalent to a 2 or a 3 minute chart. So if you're trying to replicate the same thing on your data, what you need to do is work out how many ticks on average are in a day, and then approximate that to equal a 2 or a 3 minute chart. That's what I'm trying to achieve. So my 89 tick chart approximately is around about the same on average as a 2 or 3 minute chart. So 89 ticks might not be the number that you would use, depending on your data, your charting platform, and so on. For example, eSignal, one of my training class members was using eSignal. It worked out that he needed to use a 500 tick chart to get the same approximation, because it's using their general data feed. It was an amalgamation of several sources. So there was more data, there was more information being processed. So that's how I work out my lower time frame. So essentially, it's approximately the same as a 2 or 3 minute chart. If you've not got access to tick charts, again, a 2 or 3 minute chart will give you approximately the same as what I'm looking at there. Okay, so how do I see the price action for the Aussie? I'm presuming that you mean the Aussie dollar. So let's take a look at price action, which falls in nicely with the fallback topic that I was going to go through. Before we do go on to the Aussie dollar, again, I presume it's the Aussie dollar, Aussie dollar, US dollar that you're wanting. Just bear with me. So the Aussie dollar, US dollar. Firstly, I've actually got a 240 minute chart here. Most people have access to 240 minute charts. My platform's a little bit more flexible. I would normally look at the 8-hour chart. So not everyone as majority of people do use MetaTrader, majority of people don't have the 8-hour chart. So you've got to configure your platform to be able to get that. So the Aussie dollar, US dollar, how do I see price action? Well, the first thing that I want to look at, or just recap first of all, is just a quick technique on the price action sequence. Now, this is basically looking for a series of higher highs, higher lows, or a series of lower highs, lower lows, or the transition from price moving up, making higher highs, higher lows, or the transition, to the transition down. So basically, is price trending or is price ranging? Trending up or down, or is price ranging? So the first thing I need to do is put a definition on a swing high, because when price is making higher swing highs, higher swing lows, price is going up. That's one interpretation of a trend. When price is making lower swing highs, lower swing lows, again, one interpretation is that that would be trending down. And when price is neither making new swing highs or new swing lows, then price can be said to be range bound. So the first thing I'm going to do is I'm going to define what a swing high is. So a swing high is a 3-bar combination for me. It's a bar preceded and succeeded by lower individual bar highs. A swing low is a bar preceded and succeeded by higher individual bar lows. So what I can then do is, if I was to go through that, I do it now just for speed, but if I was to go through then and mark off every swing high and every swing low, I'd be able to develop a framework to identify what price action is doing right now. So the quickest thing to do, to kind of like a quick start with price action, is to mark off the last 2 swing highs and the last 2 swing lows on the live part of the chart. And this is going to enable you to see exactly what phase of movement that price action is in. Because you only need the 2 swing highs, 2 swing lows. So we have price making high swing high, higher swing low, higher swing high, higher swing low, lower swing high, and let's just update. We've actually got a swing low there. So we've actually got price making high, high low, lower high, lower low. So if price goes below that lower swing low, price can be determined, or price can be said to be making lower highs and lower lows. The key for the pattern is when price makes that lower swing low. So when price goes below the lower swing low, then price is in a downward movement. It is making lower highs, lower lows. So right now we have price in a downward movement, having previously been in an upward movement. So that's how I see the price action sequence right now on the Aussie dollar, US dollar. Generally though, what we have seen is we've seen quite a monumental movement from around about 9,800 all the way up to the 110 level. Now, quite obviously, we can see that price, again, when we scrunch the chart up, we can see that price has pretty much been sideways since the middle of May. We've got price quite clearly moving sideways. We've got multiple touches of the high. More classical definition of a consolidation is multiple touch, at least 2, multiple touches of the highs and multiple touches of the lows. So we've got price contained between around about, I'm only approximating this, around about 104 and around about 108. So we can put a more classical definition as well on a consolidation. So we've got price having been in a consolidation, and quite clearly we've got the breakout. Now, a way of trading this, a way of tying the price action sequence into this more classical pattern would be, anyone? More classical pattern, how to actually trade that. So we've got a more classical consolidation, and using the price action sequence, how could we tie that into a trading strategy? What could we look for to participate in a new trade? Absolutely, yeah, breakout. Very simple and effective pattern. I used to trade this way for many years, many indeed. A very simple method would be to identify a period of contraction. In this case, a more classical definition of a long-term consolidation with multiple touches of the highs, multiple touches of the lows. And what we can do is we can tie in the price action sequence to determine at what point to potentially think about trades, and what point to determine that price is no longer range bound and we're potentially looking at the start of a new trend. Now, in fairness, we do have a little bit of hindsight. We already know what's happened. But with the price action sequence in mind, price has moved beyond the boundary high of that contraction point, that consolidation that we looked at when we zoomed out. So this is now the first point in time that price is making a higher swing high. So when price goes above that level, price can be said to have broken out of the resistance, so broken out of the consolidation, and you've effectively got a breakout and pullback setup, or that swing high can be determined as the pullback. So when price goes above 108.56, that first swing high that is higher than the consolidation zone that you've marked off, then you've got the potential for a new trend to establish itself. So basically, until price action tells you any difference, you're looking for longs above 108.56, that swing high. Does that make sense? A nice simple interpretation. You don't have to overcomplicate this. It's a nice simple interpretation using the combination of, again, very simple classical technical analysis, looking for a consolidation or a period of contraction, timing in the price action sequence to determine when there is a new trend or a change of trend, change of direction. In this case, a newly established upward trend at that point. Now, interestingly, we've already worked it out, marking off the last two swing highs, two swing lows. This is the point where you would stop looking for longs. Price, again, this is a fact. You cannot deny what you see. Say what you see. With the price action sequence, high, higher low, lower high, lower swing low. So below that point, or after price goes through that lower swing low, that's the point where you're going to stop looking for longs. Does that make sense, folks? Everyone happy with the logic behind just a very simple interpretation of classical technical analysis and what I term as the price action sequence? You looking for what piece of movement that price is actually in. So any questions on that? Okay, sorry, yeah, Ying, sorry, just seen your question. So the question from Ying is, if there isn't the Aussie dollar, isn't that now in a range between, what's that, 111 and 109.35? So it is in a range between 110 and 109. Well, you tell me. Say what we see. Price is making high, higher low, lower high, lower swing low. It's still trending. But this time, it's basically moved from where the blue line is, making higher highs, higher lows, and it's transitioned into making lower highs, lower lows. So with the price action sequence, is it range bound? No. It's making, again, this is a fact, you can't deny what you see on the chart. It is making lower highs, lower lows. So is it range bound? To me, no, it's not. How about stops? There's lots of ways to, so how about a more definitive entry? Well, firstly, you can use, just staying on this time frame, okay, just staying on this time frame. You could basically enter above that high swing high, that pullback as price went through the long trigger level. Through the consolidation high that we marked off, this yellow line here. So as price goes through, makes a higher swing high, you're looking for longs above 108.56, and you can essentially use that as your pullback. So, where were we? Oh yeah, so how to actually define a more definitive entry? Well, staying on this time frame, we've got a pullback entry as price moves beyond the consolidation boundary, and we can basically enter above that swing high or that pullback high there. And staying on this time frame, if I was using this as my entry, typically I'm always going to place stops past the events that caused me to get in the trade. So let's just wind back the hands of time to give you how it would be treated effectively in real time. So when that high swing high develops, this is effectively your pullback. And you, again, just for reference, you can drop down to lower time frames and use exactly the same entry method. So you could drop down to, say, the 60-minute chart, 15-minute chart, and even lower time frames depending on your personality, your profile for trading. So extend on this time frame, the pattern's going to be exactly the same. If that's going to be your trigger level to take action, you can use that as your higher time frame indication and enter above the higher swing high. This is effectively a breakout pullback setup. So entry above the pullback high, and when that trade triggers, I always like to put my stops past the event that got me into the trade. So for a pullback entry, the stops go past the lowest point of the retracement after the pullback develops. So this here is the lowest point of the retracement, just there. That's the lowest point of the retracement there after the breakouts and the pullback high develops. And again, this entry pattern here can be used on the lower time frame. So that's how I would deal with that. So for example, as price moves through the swing high, you could then drop down to the lower time frames and basically use this as your action points. You know, when price goes above that dotted blue line, but on the lower time frames, you can look for exactly the same pattern, but with a lower time frame entry and obviously lower risk on the trade. Another entry option for you would be to look for reversal bars, you know, hammers, dojis, shooting stars, etc. Rather conveniently, you've got this hammer bar formation here, which could give you an indication, or a slightly earlier indication, that that retracement low is over. Now, as we can see with hindsight, you would enter above the reversal bar high, stops below the reversal bar low. And in this case, it probably would have stopped you out. However, in the next portion of the chart, you've got another reversal bar, so you can tie this in with other entry methods. You've got a nice, again, hammer bar reversal, letting you know that that downward movement is potentially over, and the resumption of the upward movement is starting. Another option, again, just to try and give you alternative ideas, is prices retrace to what was long-term resistance and has come back down to what is now support. So one thing that you could do is look for a reversal of the consolidation high. You've got the breakout, price has pulled back, previous resistance acting as support. And again, using that price action sequence, this exact same pattern that we've just been through here. So that pattern there, high, high, low, lower high, lower swing low. Exactly the opposite would have developed here on the lower time frames. So again, you can drop down to your favorite entry time frame, having identified that this is your resistance now support level. Use the price action sequence to identify a trading opportunity. You've got a breakout opportunity above the breakout high, and should price retrace sufficiently enough, then you can use resistance now acting as support as your even earlier level to take action. But in that case, as price retraces down to support, you're looking for a reversal pattern. And it's just the opposite of this pattern here. This is the reversal pattern we're looking at. That point where on that retracement move down, where price changes direction back to up. There is one more swing. This is a 240-minute chart again. So 109.75. So how did I determine the 109.75? Let's go back. So in real time, how do we determine that 109.75 point? So what we're doing is looking at swing highs and swing lows, and we're using them as a framework to determine what phase of movement the market is in. Now that's the exact same pattern that we're going to go through in a moment can be used for an entry. The same pattern can be used on any time frame. So how do we determine the 109.75 level? So what we're doing here is with each new piece of completed information, so with each new swing high and each new swing low, again, 3-bar combination, a bar preceded and succeeded by lower bar highs, or a bar preceded and succeeded by higher individual bar lows. So with each new piece of information, with each new swing high and new swing low that develops, what you end up with is a framework of the phase of movement that price is actually in. Now, you only need to know and mark off the last 2 swing highs and the last 2 swing lows to be able to determine what phase of movement is in. So looking at the last 2 swing highs, 2 swing lows that have developed at this point of the chart, say what we see: high, higher low, higher high, higher low, higher high, and price is continuing to make higher highs and higher lows. We've actually got higher high, higher low, higher high. So what we're going to do now is, with each new swing high and swing low that develops, just leapfrog the second previous swing low to the most recent swing low. So say what we see now: high, higher low, higher high. Price is still making at this point higher swing highs, higher swing lows. So once again, with each new piece of information, we only need to see the last 2 swing highs, or reference the last 2 swing highs, the last 2 swing lows. Say what we see: high, higher low, higher high, lower high. So high, higher low, lower high, lower swing low. Can you see the transition? Price moving from higher swing highs on that upward movement. But where's the transition? The transition is when price starts making lower highs, lower lows. So price at this point of the chart has now confirmed that it is making high, higher low, lower high, lower swing low. So if price now goes below this lower swing low, price will be making lower highs and lower lows. The key to the pattern is that low swing low. So how was that determined? With the price action sequence, just say what you see: high, higher low, lower high, lower low. If price goes below the lower low, the direction in the short term will change. I appreciate we're going through this in very compact fashion. So if you want to read up on that or watch any subsequent videos, I have recorded this. It's free access for everyone at FX Street, so you can watch and view this at your own, in your own time and at your own leisure, should you wish to recap this cake. So price goes below that lower swing low, the direction will have changed from up to down. Does that make sense? Does that make more sense now, how that 109.75 level was determined? And again, the same pattern on the higher time frame that can be used to determine a direction can be used as an entry. We've already looked at this. Where was it? It was on Euro Yen, wasn't it? So we've already looked at this. So now, when I mentioned this earlier, this should make more sense. So this is a level that I'm interested in trading off. What was price doing at that point? Price made high, higher low, lower high, lower swing low. If price goes below the lower swing low, price will be pointing down. And I can enter below, on my lower time frames, below my lower swing low. Now, it didn't trigger the trade. So when, from an entry point of view, when would this void? So let's go back to the higher time frame. So when would this void? So the highest point of the pattern, in this case the bias change, and at this point of the chart, it's not yet completed. It's completed its development, but it's not yet confirmed, is what I mean. So if price goes below the lower swing low, new short direction bias. If price goes above the highest point of the pattern, then this pattern will void. And the previous direction, which was up, can be said to be resuming. So from an entry point, entry below the lower swing low, and my stops always go past the pattern that got me into the trade. In this case, it's what I call a bias change. Some of you might know this as a 1, 2, 3 pullback. Some of you might know this as a multi-point reversal. For anyone who wants to know, it's actually referenced in a book written in 1927, and it's referenced in Reminiscence of a Stock Operator. Very interesting book, and it's literally a 2-line sentence. And it's referenced as trading the first pullback. So there's the first pullback after the failure to make a new high. So there's the failure to make a new high, lower swing high. And there's the pullback after the failure to make a new high on this upward movement. So this isn't a new pattern, folks. This is probably older than the hills as far as trading is concerned. So entry below the lower swing low, stops past the highest point of the pattern, and the stop is the same, stop loss level would be the same as the void. So the void level, if price goes above the highest point of the pattern first, then the pattern will void. If price goes through that lower swing low, the pattern will complete. And ultimately, if you're looking at this from a trade entry point of view, your trade will trigger and then your stops can go past the highest point of the pattern. So right now on this chart, price is in a downward phase, and at this point you would be looking for shorts. So I think we've covered what phase of movement is the Aussie dollar in, how do I see it. We've also covered the price action sequence, rather neatly tying into what Aussie dollar is doing as well. And also basically a consolidation breakout entry technique, a few alternatives for the actual exact entries, and the bias change entry. So let's take a look at this on something I was doing this morning, just as a quick illustration. So just solid red line here, this is where I'm looking to go short below. And what happened was price retraced to my intended level. Say what we see, high, high low, lower swing low. Price goes below the lower swing low, I'm going to enter short. Until the pattern triggers or voids, I'm not interested in any of the other swing highs or swing lows. So same pattern there. We've already looked at this on Euro Yen. We've seen one here. So price made high, high low, lower swing low. Price goes below the lower swing low, the trade will trigger. Price goes above the highest point of the pattern will void, and then you can restart the process. So once again, at this point of the chart, say what you see. Price making higher low, higher high, lower swing low. The previous pattern voided, entry below the lower swing low. Now this is actually a slight variation. Let's just zoom in. This is a slight variation. Now what's actually happened here, if you just compare these two patterns, we've got high, higher low, lower high, lower swing low there. Okay, so there's the first pattern. That's what we've just been through on the higher time frame. Now a slight variation of this is price making higher low, higher high, and this time the lower swing low developed first. Again, remember I said, the lower swing low is the key to the pattern. Price goes below that lower swing low, price will be making lower highs, lower lows. Now in fairness, in real time, the last lower high for the short and the last higher low for a long, so in this case the last lower swing high is always going to be developing in real time. You're never going to see it until after the fact. So entry below the lower swing low, stop and void level above the bias change high. At this point of the chart, you can stop counting swing highs and swing lows. Does that make sense? We've got two variations of the same pattern. Both are the first point in time where price is changing direction. The only difference between them is the order of the sequence in which the swing highs and the swing lows develop. The one on the left, if you're interested, is essentially Elliott wave theory. The one on the right is Dow theory. And again, they are both the first point in time that price changes direction. So any questions on the price action sequence, folks? We've dealt with primarily when price is trending, how to determine, again, just one method. How do you pronounce your name? Nakusi? What was the second one? It doesn't really matter, to be fair. They're both the first point in time that price changes direction. But if you want to read up on it, the very, very basic level, the one on the left is Elliott wave, the one on the right is Dow theory. It doesn't really, to be fair, it doesn't matter. The key to the pattern is when price starts making the lower swing low for a short. So when you see that lower swing low and price goes below that lower swing low, price is pointing down. There's no way that you can argue that it's not pointing down, because price is making lower swing highs, lower swing lows. Now on this one on the left, we see that price made high, higher low, lower high, then the lower swing low. And price, as you can see, didn't go below that lower swing low. Price moved above the highest point of the pattern voided, so you restart the counting process, and then a new bias change is developed. The way that I would enter this, just for reference, the way that I would enter this is below 110.91. These 2 pips away, rounded down, would give me an entry at X5. Now in fairness, I actually left my previous entry order off the previous pattern, so I've actually already got a short on this at 85. Stops, when I finish this presentation, are going to go past the highest point of the pattern, which is going to go above 01. As I'm looking at a bid chart, which is the sell price, it's going to be 01 plus 2 plus the spread. I've got a preference for rounding up to a whole or a half number, which is 5, 10, 15, 20, for example. So 01 plus 2 plus the spread rounded up gives me 111.10 for my physical stop loss location. And that is how I would use, or how I do use, the bias change as an entry mechanism, as well as to determine what phase of movement the price action is actually in. Primarily these days I use it for entries. So find a level on the chart that you're interested in and determine what price is doing at your desired entry level or entry location on the chart. So that's the price action sequence, folks. Any questions? Again, we can see the same types of patterns. Again, this is things that we're looking at for my training members. We can see the same thing here: higher low, higher high, lower swing low, entry below the lower swing low. Again, there's another nice trade from earlier on this morning. Find a level on the chart that I'm interested in trading at. This red line here determines that, predetermined. That's where I wanted to participate below should price move through that. So that's exactly what happened to me. So find a level on the chart that you're interested in trading, drop down and use price action to determine your entry and stop location. So any questions, folks? Price action sequence. And to be fair, any other general questions about trading? We did start the session off with a question and answer type session that kind of derived into a quick tutorial on reading price action, or how I like to read price action and use that same price action sequence to get positioned on a trade. Rob, not really. The short answer is not really. With regard to trading platforms, Rob, I really think it comes down to personal preference. We've all got different preferences, we've all got different likes, we've all got different dislikes. So the first thing you need to understand is pretty much all platforms and all brokerage execution platforms, they pretty much do the same thing. So all you need to do is find one that does what you want to do and how you like it to be done. For me personally, I think MetaTrader is rubbish. I think it's probably one of the worst platforms in the world, and I've tried them all. I do not like it. However, that is my opinion. Ironically, the majority of Forex traders in the world love, for some reason, they love MetaTrader. Again, personally, I hate it. So I'm not going to use something like MetaTrader. So this comes down to a personal preference. What do you want to use? If you want to use an ECN platform with MetaTrader, or an ECN platform with Coronex, then that's fine. Go with what you want to use. You've got to use you've got to use tools that you like using. It's like buying a car. I mean, if someone was to ask me what car should they buy, and I said, well, you should buy an Audi, the best car in the world. But then your immediate answer back to me might be, I'll have an Audi. I don't like them. Well, why? They've got 4 wheels. They go from A to B. They all do the same thing. So what makes an Audi different from a BMW? It's your personal preference. And it's the same with brokerage choice, charting choices. It comes down to preference. What do you like to use? Does it do everything that you want? There's other factors to consider as well with your brokerage choice. Do you need support? Do you want customer service? Do you want the facility to be able to pick up the phone and speak to someone at any time in the day if you've got a problem? Do you want to be someone to pick that phone up immediately? And if you do, you're going to have to pay a little bit extra for the privilege of doing that. Now, personally, I don't mind paying a little bit extra to know that I've got what I think is, for the things that I like, the best possible execution platform, the best possible charting platform, and should there be a problem, I can pick up the phone, speak to tech support almost immediately, 24 hours a day. I can speak to the brokerage department 24 hours a day, should I have a problem. I like knowing that, so that's one of my preferences. But then with other choice of brokerage, you might not get that. So it really comes down to personal preference. What do you want to do? Any final questions? We've got, I think to be fair, we're just on time. I don't think I've got an opportunity for any further questions. Typically I overrun, just on time this time. But nevertheless, that is the price action sequence. A couple of questions, hopefully answered satisfactorily. If you've not had your question answered and I've missed it, please contact me and I will run through it. We've run through the price action sequence. In a nutshell, when price is making higher highs, higher lows, it's going up. You can't deny that when that happens, it is going up. When price is making lower highs, lower lows, it is going down. You can't deny that. That is a fact of the charts. We've looked at the transition from up, in this case to down, on the Aussie dollar, and we've looked at using that same pattern as an entry opportunity, an entry pattern into a position, into a trade. This can be used on any time frame, any chart, any market, any instrument. It is just pure price action reading. So you can use this on anything you want. And we had a quick look at a more classical consolidation and looked at the consolidation breakout and tying that into the price action sequence. We give a few different ideas for entry possibilities on this time frame and lower time frames. And that's essentially what we've done, folks. Nice and simple price action reading. When it's going up, it's going up. When it's going down, it's going down. When it's neither making new highs or new lows, it's sideways. And again, we looked at the transition from up to down. That's it, folks. That's me done. Thank you all for listening. If you want to recap or repeat the viewing of this, I believe it has been recorded for your pleasure. If you want to know more details on the price action sequence, again, please read there's an article there with a link for the price action sequence that outlines what I've just been through in more detail in text and video format. And if there is a question that you've not had answered, please feel free to use the contact form, and I'll do my best to try and get it satisfactory to you. But other than that, folks, whatever you're up to today, have a good one. And I presume everyone's had a good trading week, and whatever you're up to, have a good weekend.